Here we're going to be looking at a consolidation of an intercompany sale of a depreciable asset. And for example here, Corporation P, the parent, is going to sell a machine here to Corporation S, the subsidiary. So first let's look at Corporation P here, the parent or the seller. The machine's original cost at Corporation P is $64,000. The accumulated depreciation as of the first year that we're looking at here, January 1st of the first year, is $24,000. So the machine's book value here is the difference between those two, or $40,000 for a Corporation P. Now they're going to sell here, Corp P sells this machine here to Corporation S for $60,000. So Corporation P here has a gain on the sale of this machine here of $20,000. They had a $40,000 book value, they sell it for $60,000, so we have a gain here of $20,000. Now for these consolidations here for depreciable assets, we have to look at the base here that we're depreciating it from. So for consolidated purposes here, we use the depreciated base that we're going to depreciate this asset at here at the book value prior to the sale here, for in this case for Corporation P. And then for Corporation S, the buyer, their depreciable base here is going to be what they purchased that machine at here, $60,000. And for this example, we're going to say there's 5 years remaining in the life of this machine here after the sale. So for the consolidated depreciable base here, we take the $40,000 book value, divide that by 5 years, and we get $8,000 per year depreciation for straight line. And then looking at the Corporation S, the buyer, we take the price that they paid here, $60,000, divide that by 5 years, and we get $12,000 per year as the depreciation that the seller, or the buyer in this case, is going to recognize. Okay, let's look at how we'd handle this gain here on this sale. So the buyer here has $12,000 depreciation per year. For consolidated statements, it's $8,000 per year. So we have a difference here of $4,000 per year here in the depreciation charge here. So the $4,000 per year, that's considered a deferred gain, and it's realized by the seller over the asset's useful life here, in this case 5 years, by reducing the annual percentage charge here on this asset here. So looking at our year one here, $12,000 here for the buyer, less $8,000 consolidated statement here. So we have $4,000 here, and that's a realized gain of $4,000 for the first year here for the seller. So years 2 through years 5, we still have we'd have $4,000 here in change in our depreciation amounts, and those are deferred gains at this point. Second year, the seller would realize another $4,000 gain here on this sale, so based on the difference here in the depreciation, and it would just continue on here until all the deferred gains would be realized here up to the total amount here of $20,000. Okay, and now for our eliminating entries. First, we have to eliminate here this gain on the sale here by Corporation P. So we go up here and we'd credit the machine purchased here for $20,000, and then we'd go down here and the gain on sale, we debit that for $20,000. Next, we have to account for this change in depreciation expense here. So we'd go up here to accumulated depreciation here on the machine, we'd debit that for $4,000, and then we'd go down to our depreciation expense here in the machine purchased and credit that for $4,000. And then if you note here the $12,000 per year for the sub-corporation or Corporation S here for the depreciation expense, Corporation S, the buyer, must absorb this extra expense here of $12,000 per year depreciation. Okay, let's look at how we determine our income distribution. And for example here, Corporation P, the parent, is an 80% owner, and a Corporation S, the subsidiary, has a 20% non-controlling interest here. So first looking at Corporation S, the subsidiary, they had an internally generated income here of $50,000, no adjustments, so the adjusted net income is $50,000, so they get 20% of that $50,000, and that would give them a non-controlling interest here, income of $10,000. But what we want to look at here is the parent corporation, and they had an internally generated income here of $60,000, and then they get 80% here of the subsidiary's income. That gives them $40,000 here. But what we want to look at here is the gain realized here. So in this case, they realized $4,000 here, a gain on the sale of that machine, and that's really the first year's change in depreciation here between the $12,000 and $8,000. That was the $4,000 gain that they recognized here. And then the gain unrealized, that was really the total gain here on the machine. But what we want to look at is the difference here between the 4 and the 20. So that gives us here a total unrealized gain remaining here from year 2 through year 5. That would be $4,000 per year, or $16,000 as a deferred gain at this point. So just summing all these, the controlling interest gets $84,000 here in income here. Now, one other thing to note here: if this sale was made by the subsidiary here, the profit would flow through the income distribution schedule. In this case, this total gain here went to the parent. Okay, we'll look at the second year here and how we'd handle this gain on this machine here. So we'd have to eliminate any remaining intercompany gain here on the machine sale, and then we'd reduce the machine to its cost and adjust for any accumulated depreciation as of January 1st here of the second year here. So looking here, we'd debit our retained earnings here for Corporation P as of January 1st of the second year for $16,000, and we debited that here for $16,000 because that was what's remaining here on the gain here. We had a $20,000 original gain here, and then we had $4,000 that we realized here in the first year of 20x1. So that leaves us here with $16,000 worth of remaining gain. And then we'd have an accumulated depreciation here. We'd debit that for $4,000. That's the change here in the depreciation rates between the different bases, and then we credit our machine, or we reduce here the gain on the machine here, the balancing amount for $20,000. So if you look here from year 2 through year 5 here, we had this deferred gain here of $4,000 per year here, and that gives us this $16,000 here that we're debiting to retained earnings here, and that's the remaining gain here, this $16,000. So looking at our elimination entries here, first we would credit the machine purchased here for $20,000, and then the balancing amounts here would go to a debit here, the accumulated depreciation on the machine purchase for $4,000 here, and then debit our retained earnings here for Corporation P as of the first of the year for $16,000. Okay, next we have to reduce our depreciation expense here on the change in depreciation rates here at $4,000 per year. So we'd go up here to debit our accumulated depreciation here for $4,000. Now remember, we've got here 2 years worth of accumulated depreciation here at $24,000 here by the subcorporation S, and then the balancing amount would go to our depreciation expense here on the machine for $4,000. And at this point here, Corporation S has for this 1 year has $12,000 here of depreciation expense. Okay, for our income distribution, the subsidiary, they're going to get 20% here of their adjusted net income for $9,600, and then for the parent, they're going to get their internally generated net income, and then 80% here of the subsidiary's adjusted net income. And then what I want to point out here is this gain realized here. They're going to get $4,000 of this deferred gain here. That was the difference between the depreciation rates for year 2 here. So they get a controlling interest amount here of $142,400. But I want to go back and make this point back here where we eliminated this remaining intercompany gain here on the machine sale for the second year here. It would all went here to the parent corporation because they were the seller company. But had the subsidiary been the seller company, this gain adjustment here to retained earnings would have been adjusted 80% to the parent and 20% to the subsidiary.